What are you expecting when it comes to global equities over 2019?
Really tough year. And it's not a surprise. I think you can go back to the third quarter of last year when we saw net quantitative easing by the big central banks that were doing it go into reverse. They actually started to pull liquidity off the table. And from that point on, we knew a series of asset classes would have trouble this year, whether you're talking about equities, whether you're talking about real estate, whether you're talking about emerging markets. What's different in the last week, I think, is people are grappling with a couple of very sudden changes that have occurred. One of those, of course, is US politics, where we now have the Democrats in control of the lower house of Congress. So the whole US economy is going to move into a gridlock situation. The other one is the trade war. What that did in the final, say from July, August, September in Asia, everyone accelerated their exports from Asia to the United States. Now we're in the shadow. And the export numbers we're seeing coming through in the last few days for Asia, not just China, for Korea, for Japan, for Taiwan, are coming all the way down to zero growth. And people suddenly go, whoa, this could be worse than we thought. I think it's pretty much a difficult first quarter. No need to write off the whole year. It will be slower. It will be hard for any equity market to make a gain. But we can see these novel problems in the first quarter.
Okay, so let's, I guess, map out then 2019 as best we can. A slow first quarter. Do we then get a deal between China and the United States on the trade front, which kind of alleviates some of those concerns you were just mentioning? Or are we going to be now focused on this gridlock that we're going to see in Congress in the United States, and that's really going to dominate out the rest of the year?
The gridlock in the US economy will be the dominant story through the year. On the trade front, we've been one of the very few groups saying from around the third quarter of last year, we expect a deal to be done. Back in the third quarter of last year, we thought the deal would be done by the start of January or somewhere in the first week or two of January. The reason for that is when we do our analysis of the US and China economy, if they escalated that trade war, it would have done significant damage to both. Neither side talks about it. You don't see the President of the United States or the President of China mentioning that. It's not in their interests to say, if we escalate this war, to whack our economy. But if you're an economist and you look at it, it was really going to hurt them. So we expect a deal to be done. Of course, it's going to be some sort of fudge. And there are signs of that deal already. China's amending its regulations to provide better intellectual property protection, which is going to be one of the key issues for the US. And Trump keeps signaling he wants to do a deal. So we expect a fudge deal to go through. Trump will declare it as a great victory. It'll get this off the table. They will de-escalate and possibly remove all of the tariffs they've got. So this issue goes off the table by the second quarter. However, we are then left with a slower global economy, significantly slower than 2017 and 18. I think what people have got to realize is 2017 and 18 were really exceptional years for growth. We're not going to see them repeated anywhere in the next few years. We're in for slower growth, a more difficult environment for asset classes.
Hey everybody, it's Hadley Gamble from our new CNBC Middle East Bureau in Abu Dhabi. Thanks for stopping by. Now to watch more, you can try one of the videos that just popped up on your screen. And don't forget to subscribe.